this exercise because obtaining information costs money, usually time and energy. But these are the areas where you would want to look for informational advantage. Since public information is generally available, that would be hard to get an edge. The edge is really in this area of quasi-public and then non-material, non-public information. We'll show in a couple of slides how that gets all put together. All right, here's a couple of areas which we think are critically important to understand. The business has changed a lot in the last 10 or 15 years. It's going to change even more when it relates to information. So generically referred to as big data, alternative sources. I mean, just have a list here, which is what we came up with in our travels. But satellite images. So they have satellites that travel over parking lots and tell you how many cars in the parking lot per hour per day, and you can see that trend. So if you're looking at big box retailers and you're not looking at this information, you're potentially at a disadvantage. Next is credit card exhaust. All kinds of available information on buying patterns and what individuals are buying at what velocity and what areas. Generally costs money, but there's information there. If you're looking at anything that's consumer related and you're not looking at credit card related information, you're potentially at a disadvantage. Not an advantage, but you're at a disadvantage. The expert networks have been around for a long time, somewhat table stakes these days. Web scraping, all kinds of firms now will give you all kinds of data on social and mobile, what's going on the web in terms of sentiment and other activity. You have natural language processing. I know a couple of firms that are taking 10Qs and 10Ks. They're running through NLP, and what they're looking for is changes in patterns and recognition and flags. If you're not taking advantage of that, you're potentially at a disadvantage. And then voice stress analysis on whether or not management was stressed on the conference call as they release their earnings. And then we've heard about ex-FBI agents being on calls and giving their sense of how the tone of the call was. I think it's crazy. And then FOIA for sure has been around for a long time, but being able to leverage that. And I suspect you could come up here and add 5 or 10 other sources of information. But that's what's going on. So if you're not having, the talk is how to survive. One of this is be aware of this information, and you're going to have to leverage this information. All right, non-material, non-public information, very clear in the book and in general. This has been outlawed by the SEC. It's very careful about that. We're not going to go into it. We're not qualified really to talk about it, but we do point out that you have to be able to do this without violating these chain fence and the barbed wire, or you'll end up behind barbed wire. All right, so let's take this back. The original picture. Anybody know who the original person was? Go back for a second and see if we can. You know which one, right? Yeah. All right, go ahead. Who's that? Any ideas? Paul's hero. That helps. Who is it?
Walter Schloss.
All right, now we'll go back. We have 28 Easter eggs in the book. First person who finds all 28 will sign your book. We would anyway, but there are a lot of really fun things in the book. Walter's one of them. All right, so we go back to that processing model that we talked about for the portfolio manager. Dissemination, that's that aggregation of information. You then have processes, then you have incorporation. What we've done is we pull over here what you need information-wise. It's non-material, non-public information, plus quasi-public information, plus public information. You take, that's your source of information. You put that into a model where you process that model, ideally very well, that you come up with an estimate, and that estimate has to be a variant perspective versus the market, either a better sense of value or a better sense of timing related to that realization of value. And this is the model we essentially use. So as we talk about how to survive in an increasingly efficient market, this is in fact the model you want to start to think about. Here's your information sources. You have to have a superior model. In terms of process, you have to end up with a variant perspective. And as we say, don't take our word for it. This is a very famous ruling from Judge Mansfield. This was in 1980, the Elkin versus Liggett case, where we came up originally the mosaic theory. And Paul and I kept this in mind as we were working through the book, that this becomes very important. But essentially what Judge Mansfield has said is what we just did on this page before. Is you have to be able to take all this non-material, non-public information, stay away from that chain link fence, and get an edge. All right, so that's our formal presentation. We would love to have questions. Elliot, come on up.
Oh, let's wait. Should we go to the next?
I think go back to the book.
Yeah.
Okay, everybody slow down. Question?
So you said, in terms of the advantages, both timing is one component and then value is the other. How are you thinking about timing to get that advantage? Because timing, I guess, would be one of the hardest pieces. You know, is it the next quarter or is it 3 years from now in terms of the realization of that value, which you may have a higher earnings estimate, but it hasn't been realized within the market?
I guess a part of this is the piece is the catalyst. Okay. And we talk about it in the book, and I firmly believe that there's two types of catalysts, what we'll call hard catalysts and soft catalysts. Hard catalysts are an event of some kind, and that's the customary definition on the street, is I'm a catalyst-driven fund, I'm looking at specific events. There's a soft catalyst called time, which is just the unfolding of time. The world realizes it's a better company. We're going to have Noah jump in, because this is what he does for a living, and talk about it. But I think timing is very hard. It's the part of the business that's not taught very much in business schools or even on the street. It's kind of the old world of value investing was we didn't worry about time, we only worried about value. This day and age, I don't think you can do that anymore. It's
Well,
just
kind of what really shocked us as we were going through the book is that if you go back to like Finance 101 and you look at the formula for total return, it's how much you're going to make over what time. And then between business school and getting on the job, people kind of forget that time element to it, and they just focus all their time on what they think it's worth. So you have to have an estimate for the intrinsic value and an estimate for the time it's going to take to get to that investment value, and that's the total return. Of course, if it takes 3 years, it's a great return. If it takes 10 years, not so great.
Of course, if the market was fully efficient, it wouldn't take any time anyways.
yeah, it'd be priced in, right?
Just going to follow up on that point, is there like certain examples you have of catalysts that you're looking at stock and you're saying it's undervalued today, but we expect X, Y, and Z to happen? What are those X, Y, and Z types of events that you're looking at or that you see?
That's a great Noah question.
Yeah, that's a good question. Think about.
That's why I gave it to you.
I mean, there. You guys. Sure. So, you know, there are oftentimes, for example, I was involved, or my fund was involved in an investment in Liberty Global, international cable company controlled by John Malone, and they had 10% of their business was called Liberty LatAm, which they announced they were going to spin this thing off and use that as a platform for consolidation in Latin America. So while this was happening, Malone had another private cable asset called Columbus, and he merged that with another company called Cable and Wireless, and that private company backdoor listed into the UK stock exchange and became a leading player in LatAm and Caribbean cable. And so, when I saw those two circumstances happen and knew that, then Liberty Global said they were spinning off their LatAm assets, as part of the consolidation they were going to look to drive in the market. And once those sort of signposts were in place, within 6 months, it was announced that Liberty Global was acquiring Cable and Wireless and putting it together in its Lilac business, and would now become its own entity. So there are oftentimes things that are in the market that you speculate that could happen, but other people perhaps thought that could happen as well. But the probability I assigned to it was much higher, and it ended up playing out. So that's sort of, I think, if that helps answer your question, but an event in which there's a catalyst in the future, and it's sort of yet to happen and unlock the value.
And that's the perfect, just one thing, and that's a prime example of a pure information, a pure analytical advantage, because what Noah was doing is he was looking at the exact same data set that everyone else is looking at, but drawing a different conclusion. So if you see things that other people can't see looking at the same data set, that's an analytical advantage.
And yeah, obviously, a lot of people aren't familiar with cable and wireless or Lilac, Liberty, LatAm, and so if you want to put the odds in your favor, you should try and focus on areas where less people are looking. And so, one cable and wireless was a UK-based entity that had Caribbean cable assets, and the other one was Liberty Global was a European conglomerate of cable assets that owned Puerto Rican and Chilean cable assets. And so, all the information was there, but it wasn't simple. They were sort of obscured by where they were listed and who owned them. So information is out there, and this is an investment opportunity where we found an edge and happened to make a lot of money. So I can refute that the market is efficient.
No, you make money because the market is efficient.
Well,
You're looking for temporary pockets of inefficiency in an overall efficient market. And when the pocket opens, you take advantage, and then it closes and you make money. Is that fair?
Sure. Microphones.
Sure.
Next question. Wow, we answered all your
There's a
questions.
follow-up, wasn't there, to?
You had a follow-up, would you?
Yeah, it was basically before you actually started putting a mosaic together and you figured out the catalyst, were you in the position earlier and then this unfolded? Did you double up on the position? How is, because part of this is also risk management in terms of position sizing, or you saw it unfold and you bought it once you saw that actually occurring? I'm just trying to get a sense.
That's a good question. So we were originally in Liberty Global, and one of the fund I work at, one of our expertise and our focus is around capital allocation and high quality CEOs. That's one angle of variant perception that I think is always missed by the market, is great capital allocated, which can allow high quality business to compound value much quicker than just one could do organically, and that's always undervalued. And so as a student of great capital allocators, I read the Cable Cowboys and understood that scale is everything in cable, and that's all Malone focuses on, and especially getting scale in a contiguous region. So we actually owned Liberty Global, and I had, using some AI, I had a Google alert on with it sent me anytime John Malone was mentioned in local newspapers and articles online.
News alert is considered AI? Okay, I've been using AI for 17 years.
Sorry, I was making fun of that slide. I apologize. I've never used any of those things on those intelligent research side. I guess we're old-fashioned in the way we look at things. But so I got an alert that John Malone was merging his Columbus cable assets, private company, into a public listed company, Cable and Wireless, and so that led me to do work on cable and wireless, and so we actually own stock in both of them, and so it was really a merger without much of a premium. So in that situation, you benefit by owning both, and so as it played out, 1 + 1 = 3, and we're able to extract the value in that position.
I think that the market can be efficient until external shock happen, and it can become an inefficient market temporarily, right? I remember a quote from John McCain saying that the market can stay irrational longer than it can stay somber. So from a perspective of the investor with limited capital, when you have informational advantage, you have an analytical advantage, how do you decide to act? When you see the efficiency in the marketplace and you think, this is great, but should I act now? I mean, it's along the line of timing, but still, with a limited capital, you have to think whether you want to take advantage of the opportunities or not. So how do you, what's your take on that? How do you react in that situation? What's your decision process in order to decide whether to take the lead or not?
I guess in the book, there were certain. In terms of, it was a question in terms of timing and sizing of positions. Would that be accurate? So in the book, there are areas that we kind of walled off that we weren't going to go near, and one of them was portfolio management. So we really didn't talk about like what an appropriate position is and what an appropriate time to put it on is. Now what you're talking about falls under what we call a cost or trading advantage. And there are times in the market where people, they can't hold a position or are unwilling to hold a position. And that's exactly what happened during the financial crisis. So the information was properly disseminated and it was processed